Hello, everyone. Today on the Final Bar, I'm sitting down with Andrew Thrasher from Thrasher Analytics and the Financial Enhancement Group. We'll talk about the S&P pulling back today, finishing the day around 45.75. It's almost 2% lower from where we got into the long holiday weekend on Friday's close. Some interesting distributive patterns with technology, financials leading the way lower. We'll talk about the breadth conditions, what they might mean. Also, answer a bunch of your questions from the Final Bar mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment. We try to draw as many messages as we can, all the information we can out of price itself. I was taught that if you want to understand what's happening with a stock, with a company, with a particular asset class, start with price, start with the chart. All the other things can help you understand why the price is performing in a certain way, why it's evolving over time. But those reasons usually make a lot more sense in the rear view mirror. If you're trying to look forward, if you're trying to understand where things are headed, look at the price and look at how investors are voting with their capital. That often can be one of the most important things to do. So what can we draw out of today? We'll try to talk through some of those messages during the course of today's show. Coming out of the long holiday weekend, you have the risk assets certainly in a distributive phase. You have a lot of growth-oriented parts of the market down fairly significant today. Most of the major indexes down significantly, volatility increasing. You have cryptocurrencies coming off, and you have rates going a lot higher. It's sort of an interesting day coming out of this long weekend as we are kind of getting into the meat of earnings season, thinking about the financial sector in particular, but some of the other areas of where there could be opportunity. Earnings season often is a catalyst. It can be a catalyst to sort of reverse a pullback that you've seen up until now. It can also accentuate something that's going on. We're starting to see some distribution play out today. We have such great guests and specials on StockCharts TV. I'm excited to talk to Andrew Thrasher here in a few moments. We have other guests coming up this week. Wednesday, the 19th, we have Louis Yanis from WealthNet Investments. On Thursday, the 20th, Katie Stockton from Fairlead Strategies coming on the show again. We also have a series of other special events to highlight for you. Charting Forward, our 2022 market outlook is premiering today on StockCharts TV. If you missed our broadcast earlier in the day, no problem. Go to StockChartsTV.com. That's our on-demand platform. We basically pose to 6 different strategists where they saw the S&P going through the course of the day, what top sectors they had in mind, things about gold and defensive parts of the market. It's going to be a really good way to try to make sense about what themes and what trends may be emerging over the course of the next 11 to 12 months. So go to StockChartsTV.com if you missed that one. Also, our next episode of The Pitch is coming up next week. If you go to StockCharts.com/The Pitch, you can get more information on that one. I'll be sitting down with Jay Woods from Drive Wealth, former NYSE executive floor governor. We'll talk to Mary Ellen McGonigal from MEM Investment Research and Joe Rabel, president of Rabel Stock Research. That is a really cool discussion where we tease out 5 ideas from each contributor, and then we have a discussion as a group, and you will leave that special with a list of tickers jotted down to dig into a little further. Go to StockCharts.com/The Pitch for that next event. Let's continue on today's show with our market recap. As I mentioned, if you're looking for some signal from the short-term movements in the market, certainly distribution over accumulation. I tend to sort of describe the market overall trends in 3 phases. Accumulation, meaning buying power overweights selling pressure. You have a downtrend with more of a distribution phase where selling pressure is outweighing the buying power. And then you have a consolidation phase, a sideways trend where those forces are in equilibrium or they're in balance. Certainly feeling more distributive on a day like today when you see pretty much everything lower with the exception of energy, which is a notable outlier with the XLE up 0.4% today. But looking at the major averages, the S&P closing below 45.80, that's down 1.8%. from Friday's close. And again, we had the holiday yesterday, no trading in equities on Monday. The NASDAQ composite down 2.6%. The mid cap and small cap indexes both down over 2%. So this is certainly a risk off type of feel to the market. Just in terms of the sector distributions, if you skip energy, you'll see things like real estate, utilities performing better than some of the other, more traditionally offensive types of sectors. The VIX, by the way, up above 20. And, one of the things I mentioned in a couple interviews in recent weeks in terms of the volatility environment, I would argue that 2022 may see more time with the VIX above 20 than below 20. And I say that just based on what I'm seeing with uncertainty, all the question marks that we have. And I think the market in general appreciates certainty. It doesn't tend to like uncertainty. And if I would describe what this year so far is playing out as, it's an uncertain environment. We have a lot of potential catalysts and themes that are competing. At the end of the day, it's not real quite clear in terms of where things are headed. And so I think elevated volatility may become more the norm and less the exception. Very quickly on some other asset classes, interest rates pushing higher today. And you saw the 10-year yield get above 185, close today around 186, 187. Now, this is pretty significant because 175 was that peak from 2021. That was sort of the mid, spring into the summer. That was the peak that we saw in the 10-year yield, then went down to around 115, round tripped back up to 175 and chopped around there a little bit. Now we're actually pushing higher. And again, if I would talk about a major theme through the course of 2022 is higher rates and how the Fed, sort of implements their changing policy or the change in their policy, how that impacts the bond markets and very closely related how that goes into equities and other asset classes. You're seeing rates go higher. So if you've not really thought about what a higher rate environment may mean for your portfolio, for growth over value, for dividend yield, and just thinking about total return, I would certainly spend some time sooner rather than later thinking about that, because rates are going higher and they continue to push higher. And I think that has a lot of effects that many investors are not familiar with because we just haven't seen it in a sustained way for quite some time. The dollar index, by the way, up fairly significantly, up 0.6%, which is a heavier up day for the dollar index. That's actually a bit of the opposite from what we've seen. We've seen dollar starting to weaken, and that weaker dollar environment, I think, is one of the potential things to look at. But the direction of the dollar has big impact on a number of things, particularly things like gold and non-U.S. versus U.S. stocks, all themes that are impacted directly by the strengthening or weakening of the U.S. dollar. Quickly on commodities, gold essentially choppy through the course of the day, but silver prices higher. Commodities as a whole, broadly speaking, up a little bit, and that's why the energy sector, the number one performing sector. Cryptocurrencies over this holiday weekend. We were out of town in Florida visiting my in-laws down in Naples and try to be as safe as possible in doing so. But it was really good to see family after not being able to see them for quite some time. I did not pay a lot of attention to the market, but one of the things that stood out to me besides the movement in equities today was how cryptocurrencies have deteriorated. You had Ether bouncing off of 3,000 and then pushing higher. You had Bitcoin, getting down to 40,000 then rotating higher. Both of those, though, going into today or the last couple sessions, weakening over time. You have Bitcoin back below 42,000. Ethereum below 3,200, and I think those are certainly important charts to watch if you're focused in that area of the market. Let's look at a chart of the S&P 500. I missed Friday's show, and thanks very much to Aaron Swenlin from Decision Point for stepping in, very capably doing so, taking the final bar for Friday. We appreciate that so much. Aaron does a great job, and so I did not get to share some of these normal charts I would have on Friday, which is when we wrap the week and we look at the Mindful Investor Live chart list. So a couple themes just to tease out. Given the weakness that you saw today, the S&P is very close, I would say, within a rounding error of that 4550 level. People talking about 4,500, and that's the swing low from early December. I kind of think of them as one big level. I could probably broaden out this area to include that swing low at 4,500. 4,550, though, has been the level I've been thinking about for quite some time. That was the peak in September. When we broke out there in October, I think that was quite meaningful. When we pulled back, while we got down to 4,500, I see that as just briefly undercutting that support level around 4,550. We did it again in mid-December, and now we're right back there. And I think holding that 4,550 level means this is a market overall still in a fairly decent uptrend. There are a number of reasons why I'm concerned that the next move may be lower, and that this might just be the beginning of something deeper. And I think the momentum characteristics might be part of that too. You have the RSI getting just below 40 today. It's an important one to watch. The last time the S&P tried to break to new highs, which is at the end of last year, we got up to 4,800, but look how low the momentum was then versus what it was in early November, which is when we pushed to 4,700. So you have the market making new highs on lower momentum. That's a bearish momentum divergence. It's not encouraging. That's not a bullish sign overall. But the key is, I would argue, whether you hold support. This tells you there may be some signs of weakness. Breaking 45.50, I think a lot of people are keyed in on that level, and maybe 4,500 a little below there. We hold that range, and I think you could still be fairly bullish and be able to justify that by the lack of drawdown. We start breaking those levels, I think it'd be really hard to justify further upside as the path of least resistance, given the deterioration that we've seen. What's interesting this week is you're seeing a lot of financial stocks, and as we get into earnings season, a lot of earnings reports. Those can provide the catalyst. We're wondering what would it take to push the S&P below 45.50. It can be some key earnings misses that all of a sudden get people really nervous about the prospects of what's happening going forward. And that's what we may be on the lookout for here as we get into earnings season. Also, just to finish off our market recap, just want to point out technology at the bottom of the list here, down 2.5% for the XLK. We're so, we've gotten so familiar with technology being a leading sector, outperforming with growth over value being a key theme in many parts of 2021. So far, we're starting to see that change quite a bit. You have energy up today, technology down today in a pretty significant way. That ratio of growth versus value certainly not favoring growth recently, tilting very much to the value side of the coin. We need to take a quick break. We'll be back with today's guest, Andrew Thrasher. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. It's great to be back with you after a couple days away from the show. Hope you all had a great long weekend. A couple comments before we get to today's guest, Andrew Thrasher. First off, questions are very welcome. We're going to do a mailbag segment a little later in today's show. We'd love to answer one of your questions on technical analysis, on particular technical indicators on the StockCharts platform, how you get things to look a particular way. Just let us know what you're running into. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. There's so much great content. If you missed Martin Pring's 2022 Market Outlook with Bruce Frazier, that aired earlier last week, if I remember right. That is on there. Larry Williams' Market Outlook for 2022 on there as well. Also, our year-end content from the end of 2021, trying to make sense of things and set the stage for this year, and so much more. All on demand at StockChartsTV.com, or on your mobile device, just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, joining us on the show once again, Andrew Thrasher. Andrew's the founder of Thrasher Analytics. He's a portfolio manager at Financial Enhancement Group, joining us from Indiana. Andrew, Happy New Year and welcome back to the show.
Hey, Happy New Year. It's great to be back.
It's good to be with you. We're talking obviously in a day when the S&P in a bit of a distributive mode coming out of the long holiday weekend, major averages moving lower. We didn't talk too much in a market recap about breadth conditions. So I wanted to start there if we could. What are you seeing right now in breadth, and what does that make you think about this overall environment?
I think the first thing we have to recognize is it's been a really sloppy market. Before coming in today, we're pretty much at the same level we came into November. The S&P has been having some marginal new highs that keep getting sold back. But below the surface, we started to see in December kind of an expanding list of new 3-month highs. That's what that second column on that chart showing, a rising list of new 3-month highs. And then here recently, the bottom panel is showing 3-month lows. And we started seeing a little bit of an increase in that. So when we have both rising lows and rising highs, it tells me that we're having pretty much a bifurcated market. We're having kind of a stock pickers market where you have a lot of winners and starting to have an increase in a lot more losers as well.
It's interesting. You sort of have stocks going up and stocks going down, and the Hindenburg omen is in some ways based on that
Right.
condition, right? We have an expansion in new highs and new lows. Your second chart is getting to another breadth indicator. Talk us through this one.
Yeah, so this is all obviously as of Friday, so we're not seeing today's data here, but this is looking at the percent of large cap stocks, S&P stocks, above the 20-day, 50-day, and 200-day moving average. And what I thought was really interesting was that we started seeing a breakdown of lower lows across all three of those look back periods. Even though the market on Friday, we did have a little bit of a bounce back in price, but below the surface, we actually were seeing a continued weakness of stocks dropping below their kind of key moving averages. Before coming in today, we still had more than half the market above the 50-day. We're at 56%. We'll see what today's data looks like. But seeing kind of going into the weekend, those lower lows in some of the moving average crossovers was a bit concerning. I've been watching this study looking at, we had at one point had like over 90% of stocks above the 20-day moving average, that top panel there.
Yep.
And traditionally when we get over 89%, that's typically followed by we get down to the 30s. We see a bit of a cooling off period where we get to about 30% of stocks are above the 20-day. So we didn't have that quite yet before today. I'm guessing probably got pretty close there today after this the selling on Monday. But so I'm kind of looking for us to get a washout around the 30%. Encouraged that we still held the 100-day moving average on the S&P today, but seeing some of some weakness in the internals from a moving average perspective.
It's very interesting. Now, one area of the market that really didn't participate in a lot of ways last year was gold, right? You sort of had the sideways trend as other assets were sort of rotating around it in a lot of ways. Is this a different setup now for gold, or what are you seeing here?
Gold's been really interesting. If you had told someone coming into 2021, hey, we're going to have 7% inflation at the end of the year, what do you want to buy? A lot of people said, you know what, load me up on gold. And what did gold do? Pretty much nothing. Gold's been, like you said, sideways since July, this chart shows. We kind of came into this week butting up against that resistance right around 1830. And so really would like to see a breakout there. The second panel there, we have momentum kind of near the high end there. Bottom panel sentiment, just below 50% bullishness on the daily sentiment index. So we kind of are at an inflection point for gold bulls. They really need to see a breakout here. We didn't get it today. Gold outperformed equities, but they were still negative. And so I'm really kind of being patient with gold, would like to see a breakout there if it's going to do something. But right now, from a sentiment and momentum perspective, they're both still kind of in the bearish type ranges. And we need to see some expansion if gold's going to start acting like the quote unquote inflation hedge it's known to be, and start getting some higher prices there.
It's great. 1830, a key level to watch on your chart. And I appreciate that. Your last chart, I'm glad we got to this last one because I think it's a really interesting one. Energy, really the only sector today out of the 11 showing some signs of life. What is your chart of energy telling us?
Yeah, energy squeaked out again today. What this chart was showing, again, coming into today, so this doesn't show Monday's action, was one of the highest levels of stocks within the XLE, the energy sector ETF, was hitting a 52-week high on Friday, 76%. Going back for pretty much the last 20 years, we've never seen a level that high in a single day. Just show the strength of the energy market. The top panel there shows the average drawdown for the energy stocks. Moral of that story is there isn't one. The average drawdown in energy is less than 1%. And that's coming from, look back when we were at the COVID lows, the average stock was down about 70%, just to show the massive run that energy's had. Very, very impressive. A lot of strength there. Traditionally, when we get that many new highs, we see somewhat of a short-term pullback, but there's a lot of energy catalysts that could help it move higher. But energy right now is getting a little bit heated, pun intended. And we could maybe see a little bit pullback there in energy, but it's definitely the strongest sector in 2021 so far.
Andrew, we'll have to leave it there. Listen, appreciate so much you sharing some charts with us. As always, you do a great job of laying out some really interesting points with some fantastic visuals. Stay safe, be well there in Indiana. We'll talk to you again soon.
Thanks.
That's Andrew Thrasher. Andrew's the founder of Thrasher Analytics. He's a portfolio manager at Financial Enhancement Group. You can get to him on Twitter at Andrew Thrasher. And I love some of these charts, particularly looking at the breadth conditions. It's amazing how as the S&P draws down, as it pulls back a little bit, some of these breadth measures can be really interesting to think about participation. And again, thinking about how these have looked going into today even though you may not have expected that the market was down so significantly, some of the breadth deterioration we've been talking about, I think on Andrew's first chart or second chart, it's become pretty clear, right? Showing how stocks are not able to hold some of their key moving averages. That might be an important set of charts to watch going forward. Great take there from Andrew Thrasher. We need to continue on today's show and go to the Final Bar mailbag. As a reminder, our email is thefinalbar@stockcharts.com. We'd love to hear from you anytime. And let's get to the questions. First off, if RSI and other indicators are used for daily charts, what values should be used on 1 hour or even smaller charts that would reflect true RSI and PPO or MACD? Really good question, and I believe what you're saying is if IBM, you use the 14-bar RSI. If you're using on an hourly chart or on a weekly chart, you didn't ask, but I mean, if I'm doing a longer time frame, weekly or monthly charts, or if I'm doing an hourly or like a 5-minute chart, what settings should I use? Well, the way I would describe it is this, from my understanding, right, 14-day RSI is sort of the classic setting that Wells Wilder, determined. If you look at his book, New Concepts in Technical Trading Systems, I think it was called, written in the 1970s, trying to help him understand the movements in the commodity markets. And he developed RSI and other commonly used indicators. Now, 14-day was the one that the setting that he used, but as far as I know, it was basically on daily data that at least that book is describing. From there, though, people have adapted that indicator and use it on a lot of different timeframes. When I'm looking at weekly data or monthly data, I usually dial it down to a 9-bar RSI. And the reason why I did that is because years ago, as I was trying to actually use that indicator to understand different price behaviors and trying to understand, different markets, I found that the 14-period RSI and weekly and monthly data was just too smooth. It wasn't noisy enough, didn't have enough movement for me to really understand some of the extremes I was trying to capture. So I was able to, I basically adjusted those because I found it was a better way of understanding the price movements. And I would encourage you to do the same thing. I don't know if there's a right answer because it depends very much on what assets you're looking at. If you're looking at a utility stock versus a biotech name versus a cryptocurrency versus an ETF or a utility stock, there could be very different settings that make sense given the volatility. I usually tell people a 14-day RSI is best if you're using if you're using daily data. Other than that, you really want to experiment with it. Find settings that allow you to understand the price behavior a little better. And a lot of people like me and others that have done technical research professionally and write newsletters will, obviously share with you the settings that we use. And you'll see why we use them in particular ways, because we've found at some point in our career that has been the better way to think about it. So for hourly data, I would actually start with 14 bars because and then they go from there. And I would probably guess you want to tighten up and do a lower value, like a 9-bar RSI, because that is maybe the second most common setting I've seen after 14-bar. Because if you want something that's a little more active, a little more dynamic, that tends to work. The next question, actually very close. Do you know what made Wilder choose 14 for the RSI? Yeah, I'd encourage you to pick up that book. And I believe it's called New Concepts in Technical Trading Systems. It's this kind of thin, 8.5 by 11 size book. I read it a long time ago when part of my early career, the way I was told to learn technical indicators was to prove them all out in Excel. And I tell you, I don't enjoy thinking back. I don't think with joy on that very long, arduous process, but I'm very thankful I was put through it because now I can tell you a lot about how they're calculated and why. And from my understanding, that's Wells Wilder looking at a bunch of different settings. That's what ended up giving him the best feel of what was happening with the charts that he was doing at. But if you actually go to that book, he actually has his handwritten, basically accounting ledgers where he was proving out and calculating them and sharing with you the settings he used and why. Not just for RSI, but parabolic systems and DMI, the ADX are all in that same book. Next question, you recently mentioned a hammer that occurred on January 10th, 2022. This also occurred on December 20th, 2021. One has a white body and the other has a darkened body. What does this tell you? I think we're talking about the S&P 500 here. And I'll take a quick look here to see if that's what you're referring to. And if not, I'm really sorry, but I'm thinking this is, yeah, here we go. So on January 10th, we have this hammer candle. That's a downtrend. You have the open and close near each other at the top. You have a big down move, but the open and the close are back near the top. So at some point during the day, we went much lower, but closed back at the top. Think of it as like a V-shaped day during the trading day, and certainly as a short-term bullish indication. Worked very well here with the next couple of days bouncing higher before the downtrend has resumed. Similar day on the 20th, and you're right, sort of have the open and close here. And your question is, does it make a difference that in here, the open is above the close, and here the open is below the close. Flip that. Here, the close is above the open. Come on, Keller. And then there, the close is below the open because it's a solid candle. Does it make a difference, is your question? Not really. And any of the tools or experts that I've ever talked to, like Steve Nissen and Steve Bigelow and Greg Morris, who are big candlestick aficionados and have written those books, I don't think there's any real difference, to be honest with you. I think the main theme there is that you open near the highs, you trade lower, but then you close back near the highs. And whether the close got above the open or not is really not a super meaningful part of that. It's more talking about the shape of the trading day. So no, I wouldn't put a lot of weight on one over the other. I think the general shape, and this is the second candle is a much more ideal one. You want the open and close to be very close to each other. So it literally looks like a hammer. This looks almost like a big headed hammer. And the bigger the body is, the smaller that the shadow is, the less and less it looks like a hammer. And that's the only thing I would caution you on. Final question. I was reading this morning about bond AD lines, specifically CES, closed-end funds on the New York Stock Exchange, being used as a leading indicator for equities. Is this something you pay attention to? And is this data available on StockCharts? It's a really good question. And the short answer is no. I don't believe we have bond AD lines, particularly on bonds. What's interesting is if you look at the breadth data that we have, this is the breadth chart I usually show for advanced decline lines. And I show large cap, mid cap, small cap, which are using the S&P 500, 400, 600 indexes. And then here we're using the New York Stock Exchange, but common stocks only. So it actually gets rid of all those closed-end funds because they're more bond market related. And the idea was to get a pure read on common stocks only. We have a total AD line that includes all of the listings on there. I'm pretty sure, because I'm pretty sure on this, we don't have one that's just looking at those closed-end funds. It's something I'm going to think about and see if there's a way we could capture that and put it on there. Part of my own job here as I'm looking at 2022 is to think about some of the breadth data, think about some of the data that we're showing on here. And breadth is one particular area that we have a lot of really cool content, but it's in a lot of different places right now. And I would love to think about some of those breadth indicators. So that's one I will make a note of and take a look at it even further. It's funny is bond data is just something people are not used to having a lot of, up until the trace system was released in sort of the early 2000s, mid 2000s, if I remember right. You really didn't have a lot of great data on bonds at all. Closed-end funds are something different, but bond data in general has been a lot less transparent. It was more of an over-the-counter market. That has changed a great deal, and I'll take another look at that. The best way to find any breadth data we do have at this point is to search for keywords. Search for NYSE advancers, and you'll find the indexes we do have that track some of those metrics you might be looking for. Thanks for that question and that suggestion. It's all the time we have for the mailbag. We need to wrap today's show and go to the 3 in 3, 3 charts in 3 minutes. Here we go. We missed my chance on Friday to pound the table on some of the Mindful Investor live charts. This is my chart list that I keep maintained on StockCharts.com. To get to it, by the way, if you go to go to the articles page, my page is called the Mindful Investor, and you will find some of these charts and many others and an updated list that I keep going on our platform. The first one is the market trend model. This is my main model built on weekly data. I update it every Friday after the close, and it looks at the trends on 3 time frames: long-term, medium-term, short-term. The long-term model turned negative in mid-2020 and has remained, turned bullish in mid-2020, has remained bullish from that time on. The medium-term model now for me turned bullish in May of 2020, has remained bullish. The short-term model, much choppier. The short-term model turned negative a couple of weeks ago, remained negative on Friday's close. The medium-term model, though, is not turned negative, but it's really, really close. And that's why I want to highlight this chart. I try not to look at it too much during the week. This is part of I do look at it, but try not to, make any changes to it until Fridays. That's Friday's close is when I would lock in any changes to this. But if we do see further weakness like we saw today, I wouldn't be surprised if that puts the medium-term model negative. For me, that would be the first bearish signal I've gotten on the indicator since February of 2020. So I'll certainly be making some noise and paying attention if and when that would happen. Second chart's a daily chart of the S&P, and I thought Andrew Thrasher's take was really, really good. I love how he thinks about some of those breadth indicators, particularly in the equity markets. Aligns very well with how we tend to talk about things normally on the show. What concerns me about the S&P chart, number one, the most recent move to new highs in late December was met on much lower momentum than I would consider as bullish. We stalled at 60, which is more of a bearish phase. and the RSI is just getting below 40. A break of 45.50, I think, could be very negative. The dollar overall bouncing higher today, but has been in a weakening trend, and that has caused the US to be underperforming non-US stocks. Something to watch. Folks, that is our show for today. Thanks for joining us here on a Tuesday afternoon special. Thank you to Andrew Thrasher from Thrasher Analytics. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.